Why did Ireland become the European headquarters for the world's largest technology companies? The answer is simple. A 12.5% corporate tax rate. Major EU countries have statutory rates in the low 20s. Ireland's is half that. Apple, Google, Facebook, Microsoft, and Pfizer all established their European bases there. Why is this so decisive? This slide explains everything. In 1997, Ireland set a strategic corporate tax rate of 12.5%. By 2003, this rate was applied to all trading profits and firmly established. This was an overwhelming competitive advantage, half the rate of major EU countries. But it wasn't just the rate. Access to the EU single market, an English-speaking environment, and a skilled workforce came together. The investment agency IDA's industrial policy attracted these companies. Apple and Google set up their European and EMEA headquarters in Ireland. Facebook and Microsoft followed. Pharmaceutical giant Pfizer chose Ireland too. Direct employment by foreign companies has consistently been in the hundreds of thousands. A small nation used tax rates and industrial policy to attract giant corporations. Ireland's unique position within the EU made this strategy possible. This is what multiple statistics show. This isn't speculation. As a survival strategy for a small country, this approach had a massive impact on investment, employment, and tax revenue. And this is understandable. Look at the tax rates. Track the corporate movements. Now you can understand not just the low rates, but the rule structures, enabling profit shifting, methods to lower effective tax rates, and the relationship with international oversight. Today, let me show you the data. But even with a 12.5% rate, companies didn't pay it. They used even more sophisticated schemes. The double Irish with a Dutch sandwich. The mechanism is straightforward. First, an Irish entity books European sales. Next, these profits are transferred to a Dutch entity. Between the Netherlands and Ireland, there's no withholding tax due to EU rules. Then, from the Netherlands to an Irish incorporated but Bermuda tax resident affiliate, profits flow as royalties. This final destination has a 0% corporate tax rate. The effective tax rate ends up below 2%. In 2014, Apple paid virtually no tax on most of its European profits. The European Commission pointed out that Ireland's tax rulings resulted in Apple's specific subsidiaries having an extremely small profit allocation taxable in Ireland, dropping to the equivalent of 0.005% in 2014. However, this state aid ruling against Apple was contested through judicial proceedings. Then, in September 2024, the European Court of Justice issued its final judgment, ordering Apple to pay 13 billion euros, roughly $14 billion, in back taxes. A historic moment when previously legal frameworks were retroactively invalidated. This strategy carries serious risks. The Irish economy is overly dependent on multinational corporations. In 2022, 53% of the economy's total value added was generated by foreign-owned multinationals. Roughly 60% of corporate tax revenue comes from just the top 10 companies. If they withdraw, the Irish economy collapses. This is not a sustainable economic structure. A single top company is estimated to account for nearly 15% of corporate tax revenue. One company controls national finances. This isn't dependence, it's vulnerability. In the era of minimum tax rates, tax competition weakens, yet the risk of concentrated corporate tax revenue remains. Ireland's Fiscal Advisory Council has warned that revenue volatility and concentration represent the most significant fiscal risks. This is the structural limitation of this strategy. And this model is being forced to transform. In 2021, the OECD reached agreement on international tax reform. A 15% minimum tax rate applies to multinational groups with consolidated revenues above 750 million euros. This reform was implemented in 2024. For large companies subject to these rules, Ireland's 12.5% tax advantage has effectively disappeared. An effective 15% minimum tax, a top-up, now applies. However, the 12.5% rate remains for companies not subject to these rules. It's not a complete elimination. But the tax advantage for large corporations is gone. The double Irish with the Dutch sandwich was closed to new users in 2015. Existing structures had transitional provisions, fully ending in 2020. New tax avoidance schemes are increasingly difficult under international scrutiny. Ireland resisted, but ultimately accepted. A small nation cannot defy pressure from the EU and the United States. This is a turning point in global taxation. So why did Ireland choose this strategy? The answer lies in the reality of being small. They had no other weapons. Ireland holds no political influence within the EU, no natural resources, no large domestic market. What they had was sovereignty over their tax rates, and they leveraged it to the fullest. From the 1990s to the early 2020s, roughly 30 years, this strategy worked. But international pressure mounted. The EU demanded tax fairness. The United States viewed tax revenue loss as a problem. There are limits to what small countries can do. The power of global tax rules is far stronger. This is why Ireland could not escape. But Ireland hasn't given up. Now that tax advantages for large corporations are constrained, they're shifting to a different strategy. Competing on quality, Ireland still has advantages. It's the only English-speaking country in the EU. Abundant, highly skilled talent and high educational standards. They're investing in education, strengthening digital skills, improving infrastructure. Regulatory transparency is also a competitive edge. Cultural proximity to the United States remains attractive to companies. The shift from tax rates to quality is underway. And here's the irony. Even after the 15% minimum tax was introduced, Ireland's corporate tax revenue continues to hit record highs. Companies can't easily abandon the ecosystem they've already built, even with higher taxes. Once industrial clusters, talent, and infrastructure are established, moderate tax increases don't dismantle them. This is the power of agglomeration economies. This is the new Irish model. Now let's consolidate today's analysis. Here's what we've covered. First, Ireland's tax strategy. The 12.5% corporate tax rate, decided in 1997 and implemented in 2003, was half that of major EU countries. Through the double Irish with a Dutch sandwich scheme, effective tax rates dropped below 2%. Apple, Google, Facebook, Microsoft, and Pfizer established European and EMEA headquarters with direct employment by foreign companies consistently in the hundreds of thousands. And in September 2024, the European Court of Justice issued a final ruling ordering Apple to pay 13 billion euros in back taxes, retroactively invalidating previously legal frameworks. Second, structural vulnerability. The Irish economy is excessively dependent on multinational corporations. In 2022, 53% of total economic value added was generated by foreign-owned multinationals, and roughly 60% of corporate tax revenue comes from just the top 10 companies. If they withdraw, the economy faces severe damage. The Fiscal Advisory Council has warned that revenue volatility and concentration represent the most significant fiscal risks. This was not a sustainable model. Third, transformation and stickiness. In 2024, OECD tax reform was implemented. A 15% minimum tax rate applies to multinationals with consolidated revenues above 750 million euros, constraining Ireland's tax advantage for large corporations. But Ireland is shifting to a new strategy. It's building qualitative competitiveness through highly skilled talent, an English-speaking environment, and already established industrial clusters. Ironically, corporate tax revenue continues to hit record highs even after the 15% minimum was introduced. Once industrial clusters are established, moderate tax increases don't dismantle them. This is the power of agglomeration economies. How long can small nations maintain their own economic strategies? How far do global tax rules constrain national sovereignty? Let me know your thoughts in the comments. Thanks for watching. This channel analyzes global economics and geopolitics through facts and data. Not emotion, but mechanisms, deepening your understanding of the world. Subscribe and join me next time to explore the world's truths. Turn on notifications, and every time new analysis is published, your perspective expands. See you next time.